Hi there, I'm Mike Larson, Editor-in-Chief with MoneyShow, and I'm coming to you from the Las Vegas MoneyShow Traders Expo. Today I'm pleased to be speaking with Mish Schneider, Chief Strategist at MarketGauge.com. Mish, welcome to the event.
So great to see you, Mike. I've loved coming here for years now.
It is. It's really fantastic. It's great to see the big crowds again post-COVID and so on. So let me just start with the big picture. I mean, it seems like sometimes you hear on TV or you talk to people, they've got this laundry list of complaints and things to worry about. But I think you have a little bit of a different take about where we stand and where this environment is, right?
Well, yes, because I did a lot of research coming here in terms of what I was going to tell people as far as what's the ultimate macro right now. And what really struck me was that if we looked at life as a still photograph and we stopped it right now, everything's pretty good. The Fed has paused. Listen, we just saw NVIDIA, right? Beat, and that went up. Growth stocks have been leading the way, even with a little correction. People have more money in their pocket. Disposable income is high, even though we hear about credit card debt a lot. The government, we have a crazy debt and high interest rate payments, but that seems to be getting kicked down the road. We have war all around us, but it hasn't really had that much of a major impact at this point. There's talk of BRICS, but yet still the dollar is very strong. And we can go on and on and on with reasons why we can worry, but yet at this point, the rate of inflation, the interest rates, the lack of recession, and the fact that people are still going out and spending, and we're seeing it here in Vegas for sure, means that everything's good. Like I said, if we stopped right now, we'd be golden.
I'd be a little worried if they weren't charging us $6 for a water or something. That means that things are wrong with the economy. Let me try and unpack, one by one on some of those points. The Fed, I think Wall Street obviously 6, 7, 8 weeks ago was looking for up to 5 or 6 cuts. Now it's maybe 3 or 4, depending on what day you check the rate market. What are your thoughts on that? I guess if you'd said a few months ago that'd be a problem for the market, or you'd expect that to be a problem for the market, and it really hasn't been. So what's your take on that outlook?
Well, I have a couple of thoughts on that. Number one is, when you're talking about 5 to 5.5%, that's actually normal. If we look back historically, the fact that we got so addicted to ZIRP was not healthy. So if we could stay right here, again, going back to that still photograph, and inflation stayed where we are, the Fed really doesn't need to do anything else. And that's the rub, right? In terms of the cuts, 5, 6 cuts, I'm not quite sure why people were perceiving that to be so wonderful. I looked at that as 2 possible horrible signs. 1, recession, and 2 was hyperinflation. And that's exactly what happened in the late 70s, is the Fed accommodated just when things looked really bad recessionary-wise, and of course we saw what happened in the late 70s with inflation. So I think the Fed is good to stay where they are. However, as we know, when things are going really well, you wait for a shoe to drop, and that's going to be what happens with the Fed next. Which shoe is going to drop? Is it going to be the recessionary shoe, which seems less likely, or the inflationary shoe, which seems more likely? And that put together really is more of a stagflationary environment, not great for the Fed.
Let's talk about the economy for a little bit. You mentioned consumer spending being pretty strong. I think, you roll the clock back 12, 18 months, there were things like the Bloomberg story, 100% chance of recession. Obviously that hasn't happened, which are you in the sort of soft landing, hard landing, or no landing camp?
I'm kind of in the no landing camp right now. But let's talk about the consumer because it's so interesting. People want to talk about AI all the time. And so I've been thinking about what is the implication for people and the consumer. Because we hear, again, all the bad stuff. People will lose jobs, people will have more dependency on staying home and they don't really have to do anything. But the truth of the matter is that what I'm seeing already in a shift in the consumer is the all about we last year, where people were spending it on traveling and going out to eat, to a shift of all about me, right? So now people are starting to take care of themselves more, and I think the diet drugs, whether you love them or hate them, whether they're controversial or not, and you could certainly have the debate of obesity over side effects of a drug that prevents you from being obese. The point is that we're creating, potentially with these drugs that are so wonderful in terms of keeping weight off, a whole slew of people that have been hiding behind the door because of their weight problems, what have you. And as AI goes up and we don't really know what's even real, what's deep fake, the only way you're going to connect as a human being is face to face. So if you take that trend with AI and people having to go out, and the trend of people maybe possibly starting to feel better about themselves, what does that mean for the consumer? It means they start to spend more money on feeling good about themselves. From there, it's nicer clothes, better skincare, makeup, going to a gym, fashion, etc. So that to me is a trend that I think we really need to keep an eye on.
Okay, all right. So if we sort of take that market overview and translate it into what it means for stocks and sectors, that's got to be consumer discretionary, right? And what else sort of would fall into your promising basket for the next 12, 24 months?
Well, I think biotechnology, which has been certainly a very undervalued area, is something to look at. Of course, a lot of it has to do with what we're talking about here with the diet drugs. Eli Lilly has been an incredible performer. I'm certainly looking in those areas, as I mentioned, that really have to do with vanity and personal care. But I would not lose sight of commodities, because, especially precious metals, because if that shoe drops, which, let's face it, we can come up with several tinderboxes that can prove out to be more inflationary, sure, then the commodities that have been particularly beat up, whether it's gold, which of course 2000 you can't say is beat up, but still has been sitting and laying in wait, silver, which definitely has been beat up, gold miners even more so beat up, copper, which is kind of just sitting there. I think you'll have a lot of opportunities to kind of get this next sort of super cycle potential, and it may not necessarily affect the consumer as badly as we think, but it could affect a lot of the other sectors in the market.
Okay, any thoughts on some of the other things that people are looking at? The dollar, what's happening there, even Bitcoin and crypto for that matter?
Well, yeah, let's talk about that. So obviously the spot ETF and the move ahead of that was tremendous for Bitcoin. And the sell-off was predicted, buy the rumor, sell the news. Now we have a new one coming out potentially with Ethereum, and that's definitely helping the Ethereum market. And we have the halving event that happens in April, which means the supply of Bitcoin, which is already low, will get halved. So I think that is another one of those sort of technological advances that we cannot ignore, that are here to stay, very appealing particularly to the younger generations, and is a great representation of decentralization, even if it is somewhat regulated now. So yeah, I'm very bullish in the long term.
Got it, okay. I guess if you had to say of the risks that are out there, I mean, what's the thing that scares you the most, or could derail your generally bullish kind of outlook on those markets?
I'd say right now geopolitics, really. We all know what's going on in the Middle East, and everybody has their eyes on oil, which is flirting with that $80 a barrel. Obviously, as I mentioned, gold is sitting there laying in wait as if it knows something. But I also think that we have to keep an eye on what happens with Russia and China and Putin in particular right now, and the dollar and BRICS. Those to me are the biggest risk factors. But again, when? Yeah. That's always the key, the timing of everything.
Got it. And I guess one last question I'd ask, is you brought up NVIDIA, and obviously we all know the story of the Magnificent Seven. Can't even get that out of my mouth there. What's the next Magnificent Seven? Or do you think we're going to be in this environment where those kinds of stocks continue to lead and there's still not that broadening out of the averages?
Well, I'd like to think that if things really did normalize, we might start to see much more opportunity within the small caps. I mean, we're certainly seeing in the transportation sector, of course, a lot of it having to do with Lyft and Uber. That actually got very close to new all-time highs, hasn't quite made it yet. So I think growth stocks, when something is in momentum, it stays in momentum, basic physics. So I would not discount the fact that if things stay roseate, technology will continue to outperform.
Got it.
But I do think that there is an opportunity if we can get through all of the politicking in this election and start to actually put some money into the United States in terms of our own industry. That will help the tech companies, but also may help a lot of those small cap companies as well.
Got it. Excellent. Well, Mish, thank you so much for sharing some of your insights here. Hope the rest of the conference goes great for you, and we'll talk to you again.
Thank you so much for talking to me.
I also sat down with Kenny Polcari, Chief Market Strategist at SlateStone Wealth. Kenny, welcome.
Mike, it's always a pleasure. I always enjoy this event.
Yeah, I'm glad you could do this podcast here. Let's talk a little bit about the markets, right? And I'm gonna just jump in for anybody who may not have seen this. Yeah. You're one of the earlier observers who was saying the Fed was not going to cut as fast as Wall Street thought, and that might be an issue for the markets. Why don't you talk about that call a little bit?
Well, and I'm still in the camp. I actually don't think they should cut at all, because I don't think the data requires that they cut. And they've been very clear about the data.
Yeah.
And I think, at the end of the year last year after the November meeting and the dot plot, and they suggested that, the thinking is starting to be that maybe there are going to be some rate cuts. That went from maybe some rate cuts that were going to be 5, 6, or 7 rate cuts in 2024, which made zero sense to me on a number of levels. Yeah. Number one, because the data wasn't suggesting that the economy was going down the drain and that we needed to cut rates was number one. Number two, think about this historically. 5, 5.25, 5.5 is not out of the norm. No. Listen, it's out of the norm if you look at what happened between 2007 to 2024 or 2023, when rates were held at zero for 15 years. That was out of the norm. But you know what? There's a whole generation of investors and portfolio managers who only know that 0% interest rate, and so to them, 5% is like, oh my God, rates are so high. And I want to laugh because they weren't around in 1979 when rates were 21%. No. You know what I mean? And so I laugh about that. And I say, at 5%, that's really normal. So to me, I never understood, it was very illogical that they pounded their feet to cut rates. And so therefore, I was in the camp that they weren't going to do it. And the data continues to confirm, I think, that they're not going to do it, or at least not do it to the extent that the market was expecting. I don't even think, listen, if we get one rate cut this year, I think that's okay, I'll go with that. I don't think you get more than that. I just don't see how. First of all, they're not going to cut in March. They're probably not going to cut in May. And then, you get into June, and within that 6-month window of a presidential election, which is a whole nother conversation about the Fed not moving on rates up or down 6 months prior to an election, because then for fear of being seen as political, right? And so once you get into that 6-month window, then it becomes, in my mind, even more difficult for the Fed to then convince the markets and people why they have to do this. Yeah. And if the data continues to be strong, unemployment continues to remain at historic lows now, 3.7%, and the PMI numbers and all the other data points are not circling the drain, why do we need to stimulate the economy and risk igniting inflation all over again?
Yeah, so you seem to be, I guess, forget the soft landing or hard landing, you're kind of in the no landing camp, right?
Yeah. I don't think, listen, if you had asked me a year ago, I would have said we were coming in for this really crash landing. Yeah. But I don't think we're doing that anymore. And I don't think we're coming in for this soft landing either. I think we're kind of in this purgatory at the moment.
And yet here we are. We just, had S&P 5,000. We've had a little bit of chop as in the last few days as we're recording this. But generally speaking, markets seem to be okay with that. Why?
And so the markets are okay with 5% rates because that's honestly, historically, that's fairly normal, right? And so I think that's why. I think that's one reason that the market says, okay, these are really normal, so we can function with that. But listen, let's be honest. The economic data has not been horrendous, right? The economy is strong. Technology is certainly driving the action because we are now in this new technology revolution. Let's just say it for what it is. AI is not going away. And it is driving. It's like every revolution. It was the Industrial Revolution, right? And so this is now. It's going to change the world. And so I think that's also part of the reason that there's all this excitement. Now, is it too excited? Have they taken valuations to levels that I think are stretched? Sure. Yeah. But, we even saw that over the last couple of weeks in this earnings season when we saw, all the big names report, and they all reported great numbers, and what did they do right away? They sold them off, right? No matter what. Apple earned $119 billion in 3 months. 3 months.
Unbelievable.
3 months, and yet they sold that stock off because they were disappointed that they only earned $20 billion in China, not 25. I'm like, really? It doesn't make sense to me, right? So I think that the market would be okay, and I think it is okay if we stay right here. I don't think the market really wants. The traders are the ones who want the lower rates. I think the market's okay.
Okay, all right. Let's talk. You brought up tech, obviously, and like you said, there's this sort of two-way thing where you've got great earnings, changing the world and so on, and yet the short-term market reaction is throwing a hissy fit and pulling back. So how do you think that situation resolves? Does money rotate out of tech to other sectors? Does it come right back in a week or two? What do you see happening?
Well, so here's what I think. I think money has to start to rotate out, and we're starting to see a little bit of that. Partly because the tech sector has now become, in portfolios, it becomes overweight in the portfolio, and so the portfolio managers have an obligation to manage their risk. And so I put this in my note this morning. People always think, Vanguard is selling Amazon or Vanguard is selling Apple, or, there must be something wrong. No, Vanguard owns 225 million shares, It's now overweight amongst these portfolios. They need to manage that risk. And so you have to be careful how you make assumptions on why people are selling and why people are buying, right? Everyone buys and sells for different reasons. And so I think it's all about managing risk. But I do think that we're going to see, just because it's so outperformed, is that money has to be reallocated into other sectors, right? Wherever they are, whether it's small caps, mid caps, whether it's healthcare. I think healthcare is going to do very well this year. In fact, it's up 7% so far year to date. It was one of the underperformers in 2023.
Yeah, that's a great point. And I think you had a wonderful piece the other day. I read your stuff and I watch your videos. It was on the industrials. Now, what are you going to do? Freak out, one day, and then 2 days later it's above where you freaked out.
And that's exactly the point, because that happened with the CPI. No, it was the CPI, right? The CPI came in 0.1% hotter than expected. Okay, so it is moving up. It didn't go down. So the fact that it went up was a little bit unnerving, right? And then the PPI on last Friday was also even hotter than the CPI, which just leads us into another conversation. We'll talk about that in a minute. But what happened when the CPI came out and the market threw a hissy fit, the Dow was down 800 points and the S&P was down 100, all this stuff, and it was like the end of the world. And I'm like laughing because the XLI was a perfect example, right? People hit the sell button, they just sell everything, right? And then 2 days later, the CPI didn't make a difference anymore, and everything had rallied right back. So I think to myself, okay, if you're a long-term investor, you sold your XLI because you panicked, sold everything, and now you got this cash and the market went right back, and now you want to jump back in. What did you really accomplish? Yeah. Nothing. Right? You spent a lot of in and out. That's what you did.
Sure,
you just churned your account. For what?
Yeah, no, I hear you. If we put our intermediate terms, I guess you could call it long-term hat on, say, what do you see happening over the course of the year? I mean, do you think we're going to be challenged for a little bit as markets digest what happened in tech? Where are we going?
Yeah, so I think the rest of this quarter takes us to the end of March. I think the market's going to churn and backfill a little bit. I think it has to, because if you just kind of look at the action, it got ahead of itself, and it hasn't had a chance to catch up. Yeah. And so I think you're going to have this back and fill. I think it's between 5,000 and 50-50. It feels toppy to me. Okay. We've tried it a couple of times. We've backed off every time. We've traded low, and now with these, with the tech earnings season, and now with some of these latest tech numbers, which have not been bad, but yet it's caused the trader types and some of the asset managers just to take some money off the table. Of course. Listen, everything was priced to perfection. So the path that leads resistance had to be down, because even if they came out and said everything's perfect, someone's going to say it wasn't perfect enough. Sure. Or they didn't use the right word in this sentence, so I'm nervous. It's ridiculous, right? But that being said, I do think that we're going to see kind of some churn this quarter, and then I do think by the end of the year that the market is going to be higher. I'm calling for the S&P to have a 10% move, which would take us to about 5150, okay, right? At the end of the year. Now, we traded all the way up to 50-50, so that didn't seem really dramatic, but when you think about it, that was already up 8% from where we started the year, right? And if you're only expecting a 10% move, then you're there already, right? I also think, and let's just talk about the big elephant in the room. The presidential election is certainly going to create some chaos, not only in the nation, but I think it can create some economic chaos, and I think it can certainly create some market chaos. But you and I both know, politics can do that, create short-term chaos. But in the long run, politics do not price stocks.
Yeah, it's economics, it's earnings, it's all that.
But it does create an opportunity, because when people get nervous and the chaos creates, and people make these rash decisions, is when the opportunities are created.
For sure. In the time we have left, anything you want to offer, and if the answer is no, it's no problem, on some of these other asset classes, I mean bonds, Bitcoin, gold, some of the other things people are talking about.
So listen, here's the deal, and I like gold, but as long as rates remain higher, the dollar's going to remain strong and gold will be under pressure, right? So I think gold is going to be stuck in the 2020-50 range, which is where it's been churning now for the last couple of weeks. You look at it, trades down at 2030, trades back up to 2050. Now, the other day when the CPI came out, there was all this panic that actually the rumor went from rate cuts to possible rate hikes, and they killed gold. They took it right down to 2,000, where it found some support. But I think it's going to stay there. I think the dollar, as a result, is going to remain relatively strong, because I don't think they're going to cut rates, and so therefore the dollar will stay where it is. Bitcoin, I own a little bit of it, not a ton, but for me, it's more like I'm just wetting my feet. Do I think it's exciting and all that stuff? Yeah. and I'm excited to see where it goes. Everyone's calling for $100,000 Bitcoin by the end of the year. I only hope so, right? Yeah. But if it doesn't go there, I'm not gonna lose any sleep over it.
Sure. I guess one last thing I wanted to ask you. You were talking about 4 key themes in 2024 here. We've already touched on politics. I guess that's one of them, right? What are the other major drivers that you think are going to be the biggest issue for this
Well,
year?
listen, the themes were the presidential election, the politics, right? So that's the first theme. The Fed was the second theme. Economics, right? And are we in for a soft landing or are we in for a hard landing? And then really the geopolitical issues, right?
That's the one we haven't talked about.
Right. And again, the geopolitical issues create chaos and create uncertainty and create nervousness and angst. But really in the long run, in the end, like national politics, it doesn't price stocks in the long run. It creates opportunity because it creates chaos. But I do think that the geopolitics in the Mideast are going to continue to remain elevated. And the fear is that we as a nation get drawn now into a third conflict that we don't really need to be. But the fear is that we're going to get drawn into that, and I think that could potentially then cause some angst amongst the nation and amongst investors, and that will be another reason that maybe the people will go more safety and try to go into treasuries and take the risk off the table.
Got it. Well, Kenny, the sort of cautious optimistic outlook, I guess, is how I'd summarize it.
Right. Because I'm listen, I am bullish, but I do think the next month and a half, to the end of the quarter, is going to be, people should expect some churn and move lower. But that's actually okay to shake the branch a little bit to see who falls out, right?
For sure. Well, Kenny, thank you so much for taking some time out here at the Money Show. This has been Mike Larson with the Money Masters Podcast here on site in Las Vegas. Have a great day.